Is Bloom Energy a buy or a sell? Let's get started with the model. This is a mid-cap company, 4.8 billion market cap. They're trading at $21 a share, and they have 227 million shares outstanding. Bloom Energy designs, manufactures, sells, and installs solid oxide fuel cell systems. Solid oxide fuel cell converts fuel to electricity. The company offers Bloom Energy Server, a solid oxide technology that converts natural gas, biogas, or hydrogen into electricity. It sells its products through direct and indirect sales channels to utilities, data centers, agriculture, retail, hospitals, higher education, biotech, and manufacturing companies. It was formerly known as Ion America and changed its name to Bloom Energy in 2006. Incorporated in 2001, headquartered in San Jose, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They haven't hit break even yet. Negative free cash flow each year. 2023 was their worst. It got a little better in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is the sales for the company, and that did go up from 2021 to 2023. It came down a little in the trailing 12 months. So they probably need to get to $2-3 billion before they become profitable. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $4.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3.5 billion. We divide that by 227 million shares. And we get a calculated stock price of $15. They're trading at $21, so they're trading at a 39% premium. It's a sell according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 44 companies in the same industry as BE, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spent $64 million in CapEx. Most companies in this industry don't spend much in CapEx. Plug Power spends the most, $479 million. They have one of the worst debt-to-equity ratios on the list. For every dollar of equity, $3.90 of debt. They don't pay a dividend. A lot of companies in this industry do pay a dividend. Energizer pays the highest, 3.6%. ENR is one of the largest manufacturers of batteries. I'm sure you've seen the commercials. Their free cash flow is negative, so it's a lot worse than the median average. They rank 6th in market cap. Vertiv is the biggest at $47 billion. Price to book is 7.7, which is better than the average. We can't look at that PE, they have negative earnings. We can't look at that price to free cash flow, negative free cash flow. Price to sales is okay at 3.8. That means investors are paying $3.80 for $1 of revenue. They generate $1.3 billion of revenue. Look at Novonix, only $7 million with a $25 billion market cap. BE is still growing. Their 5-year annual revenue growth rate is 13%, much higher than the median average. Plug is the biggest at 27%. If you put $10,000 into this company when they started trading in 2018, you'd have $6,300 today, a 37% loss. To summarize, I have them trading at a 39% premium, ranking 5 out of 10. I'm not too sure about this company. I'd have to do a little more due diligence. Would I buy them short-term and long-term, 5 out of 10? I'm not too sure. I definitely have to do more homework on them. Ratios look pretty weak, 2 out of 10. And financials aren't so great either. They always have negative free cash flow, so 3 out of 10. Let's look at their third quarter earnings slides. Revenue is down. It was $400 million in the third quarter of 23. Now it's $330 million, down 17.5%. Product and service revenue is down even more. It's down 19%, which is most of their revenue. Margins are down 31% to 25%. Operating income went from $52 million to $8 million. EBITDA $66 million to $21 million. And their EPS went from 15 cents to a loss of 1 cent. Here's a breakdown of the revenue, the $330 million. $234 million is product, 51 service, 32 install, and 14 electricity. In product, gross profit $81 million, so margins 35%. Electricity is also good margins, 31%. But service is only 2%, and install is a loss. $32 million of revenue, $35 million of expenses. Expenses are higher than revenue, which gives them a negative gross profit. So every time they generate revenue, they're losing money. It may be because they have low revenue. Once they get up to a higher number, say 100 million, 200 million, then I would hope they would have positive gross profit. Because usually when you scale, your expenses go down. Not go down in a nominal sense, but go down as a percent of your revenue. So currently their revenue is 32 million, cost of revenue 35 million. So say they had 100 million of revenue, 90 million cost of revenue. So both numbers went up, but expenses went up less. So in that example, their gross profit would be 10 million, 100 million minus 90 million. Last year, their margins were much higher in product and electricity, but much worse in service and install. About half their revenue is in the US, half international. Last year, it was 2/3 US, 1/3 international. In the third quarter, they burned 90 million of cash. They started with 638 million. Then they had an operating loss of 70 million, an investing loss of 14 million, a financing loss of 6 million. Last year, they added 50 million of cash because financing was so high. That means they either took on a lot of debt or diluted a lot of shareholders, or of course a combination of both. When you analyze a company, you want to focus on operating cash flow. That's the most indicative of how the company will succeed in the future. Financing will always move around a lot, whether you take on debt or equity or pay back debt or equity. Here's a breakdown of their operating expenses. I like how they lay out everything nicely. 75 million of operating expenses, 31 million of R&D, 12 million of marketing, and 32 million of G&A, which is almost identical to last year. Last year was 76 million. They're investing in electrolyzers, hydrogen fuel cells, and carbon capture. Electrolyzers use electricity to split water into hydrogen and oxygen. In the beginning, I talked about hydrogen fuel cells. It's when you take a fuel and convert that to electricity. I have no idea how they do it, but I know that's what it is. I heard carbon capture could reduce greenhouse gas emissions by up to 14%. Carbon capture is supposed to remove CO2 from the air. Normally, CO2 goes into the atmosphere and does harm. But instead, they're going to capture the CO2, compress it, transport it to a well, and then inject it into an underground reservoir. Once again, I have no idea how they do that. I just know that's what it is. So their 2024 revenue outlook is 1.4 to 1.6 billion. Gross margin 28%, operating income 75 to 100 million. Third quarter revenue 330 million, cost of revenue 252 million. So their gross profit 79 million, 3.8 million of stock-based compensation, not too high. Gross margin 24%. Here's how they calculate their adjusted EBITDA. You start with your net loss of 15 million, then you add back 17 million of stock-based compensation. I thought it was a lot lower. Here's their 3.8 million of stock-based compensation, but this is above operating income. It's only the stock-based compensation in cost of revenue. They also have stock-based compensation in SG&A and R&D. So total stock-based compensation for the quarter is 17 million. Depreciation and amortization 13 million. So you add those back for adjusted EBITDA. That's how you get positive 21 million of EBITDA. Still a lot lower than last year of 66 million. I'm recording this video on Saturday, 11/16. Yesterday, Friday, 11/15, the stock went up 59%. It looks like it opened up on Friday at 13 or 14, closed Friday over 21. Let's see why it went up so much. Bloom Energy shares surge on AEP deal for data center fuel cells. Just getting a big contract could help your stock price go up, well before you earn any money from that contract. Shares soared intraday Friday after American Electric Power said it would use the company's fuel cells to supply data centers. AEP said that the Bloom fuel cells would provide a quick solution to add power as the industry struggles to meet rising electricity demand. So this is a great alternative to traditional electricity, especially as electricity goes up in price. Bloom shares were up 49% to 1974. At one point, the stock was up almost 70%, but there was a sell-off because people wanted to take in their gains, capture those profits. You can't fault them for that. A big win for Bloom as it opens the door for other agreements. This provides proof that Bloom's fuel cells are a viable option for powering data centers, as the grid remains power constrained with load growth. AEP has agreed to use 1 gigawatt of Bloom's fuel cells. Fuel cells can be installed far faster than upgrades to the grid. This will help supply AI data centers that require as much power as entire towns. After decades of stagnant growth, utilities are facing a surge in demand from data centers, new factories, and EVs. Building new power plants and upgrading electric grid takes years, which leaves utility companies limited options for short-term growth. So there you have it. That's the reason. Let's look at Bloom on Simply Wall Street. Its last price, 21, $3 billion market cap, up 60% in the past week, up 68% in the past year. In 2018, it was trading at 28 bucks. It did fall to below $3 in 2019. Amazing time to pick it up. And that was pre-COVID. Over the next year and a half, it ran up to its all-time high, 43 bucks in February 2021. Even with this big surge, it's still trading at 50% that level. Over the next few years, it was up and down, but mainly down, especially in the past 6 months, except for Friday. You could see right here on Halloween, it was trading below 10 bucks. It did go up nicely over the next couple of weeks, but then the huge surge on Friday brought it to a 52-week high. Because here's the past 52 weeks, and you can see it's well above any previous number. The highest price before yesterday was 17 bucks in May. So if you bought it in May, I'm sure you're pretty happy you're finally above water and not drowning. Simply Wall Street is at $18. They say the stock is 19% overvalued. 22 analysts priced this stock at 17. They also say it's overvalued. Their revenue in 2014 was $250 million. Then it fell to $1/8 billion. You like these fractions, right? And then it grew from 125 million to 1.4 billion. Quite a growth. It has come down since the peak at 1.26 billion currently. They do have a lot of debt, from 469 million in 2014 to 1.4 billion currently. And equity is always lower than their debt. For a few years, it was negative equity. It's finally positive, but a pretty weak debt to equity ratio of 320%. And all their equity is cash. So they have $500 million of cash, enough to service the debt. The CEO's salary went from $500,000 to $800,000. Tenure as CEO, 24 years. Total compensation, $1.7 million. Within the past year, lots of insider selling, no buying. I'm sure all these people are upset. They sold when the stock went up a lot yesterday. 86% of the companies owned by institutions, 10% by public companies, and 3% by insiders. The investment firm Columbia Management, located in Boston, owns 18% of the company. They probably did a big dance on Friday. SK Inc., the South Korean company, owns 10%, then Vanguard, BlackRock. One of the largest sovereign wealth funds, Kuwait Investment Authority, owns 3.3%. Since it's a sovereign fund, it's run by the Kuwaiti government. The largest sovereign wealth fund is the government pension fund in Norway, 1.1 trillion. Then in China, 940 billion. Abu Dhabi, 680 million. The one we're just talking about, Kuwait Investment Authority, 592 billion. Then you have China, Hong Kong, Saudi Arabia, China, Singapore, Saudi Arabia, Qatar, China, UAE, United Arab Emirates, another UAE fund, South Korea, Australia, Iran, Russia, Libya. The Alaska Permanent Fund, 66 billion, that's in the US. That was started in 1976. Their employee count went from 1,400 to 2,400. When employee count goes up, that's a bullish sign. That indicates there's demand for their products, so they have to hire people. And the ticker trades on the New York Stock Exchange, Deutsche Börse, London Stock Exchange, Wiener Börse, and Mexican Bolsa. If you click on the video in the top right corner, I show you how to create your own discounted cash flow model in Excel, step by step. It's pretty simple to do. Just watch the video. Try to watch it 100 times in a row.